Thanks for clicking. All eyes were on the Bank of Canada this morning as most onlookers, the majority of economists, were predicting a 75 basis point rate hike, the largest since 1998. However, much to the surprise of almost everybody, except for the 16% that voted on this poll, the Bank of Canada went a full 100 basis point rate hike. So a full 1%, 100 basis point rate hike coming from the Bank of Canada.
Yeah, holy
So the Bank of Canada has now raised interest rates by 225 basis points this year, with many starting to question the extent to which this will impact Canada's housing market going forward. While those with variable rate mortgages and adjustable payments will be most immediately impacted, and those with home equity lines of credit, there is a growing concern that those with variable rate mortgages but static payments, where when prime rises your payment stays the same but less money goes towards principal, there is a growing concern that those mortgages are getting closer and closer to the trigger point. That is, the point at which the bank forcibly renegotiates the loan.
You have 24 hours to give us our money.
So what I want to do today is go over the Bank of Canada's announcement, discuss the impact on holders of variable rate mortgages, both those with adjustable and static payments, go over the trigger point, and then take a look at what to look for next. Speaking of what to look for next, we are expecting the release of Canada's Monetary Policy Report, which will have predictions in it for the Canadian real estate market going forward. We'll obviously have updates out on that report on this channel. If you want to get those updates, make sure you click like and subscribe. But for now, let's get into this rate hike. As mentioned, the Bank of Canada shocked the markets today with a 100 basis point rate hike, bringing the policy rate up to 2.5%, or 2.25% higher than its pandemic lows. Aside from increasing payments on home equity lines of credit, the 100 basis point rate hike is going to put even more pressure on holders of variable rate mortgages, both those with adjustable rates and those with static payments. Canadians holding adjustable rate mortgages will obviously be seeing their mortgage payments increase substantially, with CMHC recently releasing a report saying that 53% of Canadians took out variable mortgages in the latter half of 2021. This is not a good sign. So let's take a brief look at payments for those with adjustable rate mortgages before moving on to what's going on with the fixed rates and the trigger points. If we look back to December 2021, when Canada's benchmark house price sat at $811,700, a decent variable interest rate at that time was prime minus 0.85, with prime being 2.45. So buyers were paying roughly 1.6%. If we use minimum down payment requirements on that benchmark house price and a 1.6% interest rate, we see that buyers' monthly payments were a little over $3,000, with $2,051 going towards principal and a little over $1,000 going towards interest. Using the same scenario, but including the 225 basis point of rate hikes that we've seen over the past 6 months, that payment bumps up to $4,082, with $1,561 going towards principal and $2,520 going towards interest. So we have a $1,000 increase in the payment, and we see a major flip with much more money going towards interest than principal. These numbers are obviously going to be marginally skewed as some of the payments have already been made.
It's better that you've apologised.
But you get the idea. We see a $1,000 increase in payments in just a little over 6 months, and we see a major flip with a majority of that mortgage payment going towards interest and much less going towards principal than it was 6 or 7 months ago. But what about those with variable rates and fixed payments, where as prime rises, less money goes towards principal and more money goes towards interest? What's been going on with those payments? For those with fixed payments, as we just saw, the amount of the payment going towards principal is diminishing more and more over time. And there's definitely a real worry out there that these mortgages are going to be reaching their trigger point. That is the point at which the mortgage payment isn't even enough to cover the interest owed on the mortgage. Looking at the previous scenario yet again, recall that the interest owed on that mortgage was a little over $1,000 when rates were 1.6. Now that the variable rate on that same mortgage has risen to 3.85 after today's announcement, there's $2,520 in interest owed, and if rates go up by another 50 basis points, that interest payment will rise to a little over $2,700. So if we see interest rates go up by another 50 basis points, we're only $300 away from that trigger point for a lot of banks, the point at which the bank looks to renegotiate.
I think I want my money back.
According to TD, there are a few options available for renegotiation, including extending the amortization, increasing the payments, or paying off the entire mortgage at once. Generous. And while this might seem far off, we're more than halfway there. Recall on that mortgage where the interest payable was $1,000 at the beginning of 2022, and that payment, the interest portion due, is up $1,500 in just over 6 months, and that's only with 225 basis points worth of rate hikes from the Bank of Canada. Many are expecting the bank to go up to 3.5%, or another 125 basis points by the end of the year. If the bank does go up to that 3.5%, then the interest due on that mortgage on that $811,000 house is $3,023, leaving a principal payment of around $30 on that $3,050 original mortgage payment. And that's just by the end of 2022. That's assuming that the Bank of Canada stops raising interest rates at the end of this year. They may not reverse, but that's assuming they stop, and it's not clear that that's the case as of yet. The U.S. inflation rate just came in this morning at 9.1%, and Canada is probably trailing close behind. So, if these rate hikes do not work to get inflation back down to that target range in that 3 or 4%, actually 2 to 3%, but let's say in that 3 to 4% level by the end of 2022, then we could be seeing even more rate hikes come 2023. And as we just saw, once we hit 3.5%, any more rate increases on that benchmark price in December with minimum down payment requirements, that trigger point will be breached. Now, most of the banks, most of the lenders do have different trigger points. Most of them are where the payment no longer covers the interest, but if you're curious as to what your trigger point is, you should be able to find it in your original mortgage commitment or in the papers that you signed at the lawyers.
God, I hate lawyers.
So, the Bank of Canada has raised rates, much to the surprise of everyone, to 100 basis points. And news at 11, it will be affecting those with adjustable rate mortgages. But there is a growing concern that it's also going to affect those with fixed rate payments. That if rates go much higher than they have, if they do top out over that 3.5%, we are going to start to see these trigger points be breached, where holders of these static payment mortgages are forced to renegotiate their loans. And then the real worry has always been, with the writing on the wall, with it being quite obvious that rates are going to continue to go up as values go down, we're going to see the holders of these variable rate mortgages flood the real estate market, trying to get out while they still can, trying to get all the equity out of their house while they can still afford it, before the market shifts too much and they're upside down. That is, they owe more on their house than that house is worth. We will continue to have updates out on this channel on the Bank of Canada and on the interest rates and how that affects the housing market. If you want to get those updates, make sure you click, like, and subscribe, but thanks so much for watching.